Hello to all of our viewers. My name is David McGann. I'm a director here at BMO InvestorLine, and I'm thrilled to be co-hosting today's webinar on options, exercise, and assignments. This comes to you as part of our webinar series that seeks to unpack options trading. Be sure to check out our education hub to find other webinars in the series that may be of interest to you. Once again today, we'll be joined by our friends at OptionsPlay, and I'm pleased to introduce Jessica Inskip. Jessica is a director of education and product at OptionsPlay, where she focuses on bridging the gap between education and complex financial products. Her work is featured in esteemed firms and exchanges, including Fidelity, Merrill, TD, and NASDAQ. She has held diverse roles in brokerage firms, including specializing in high-frequency trading, complex options, and derivative strategies. We're pleased to have Jessica back here with us today to go through some great content on options, exercise, and assignments. And with that, Jessica, I'll hand things over to you.
Thank you so much, and absolutely a pleasure to be here. It's so important to talk about the complexities that is options, especially exercise and assignment can be an interesting topic. So happy to dive in today. So first and foremost, know that options can be complex, and that's because not only does it derive from an underlying security, but we add this layer of complexity, which is time and implied volatility, which affects the price of an option. And because it contains the right to buy or sell, there's this component of exercise and assignment that can lead to heightened attention. It requires position management, but that position management starts with understanding concepts and how they work, that being today's exercise and assignment. So we understand the exercise and assignment process, then that helps us understand the type of strategies that we're deploying and what happens in those type of events, if you will. So nonetheless, before we dive in, it's important to talk about some disclaimers. Like I said before, options are complex. They're not necessarily for everyone, which means that there is certainly a lot to learn. There are lots of disclosures that you would see. Any information that we are using today is purely for informational and educational purposes only. OptionsPlay, of course, is that third party bringing on today that we're discussing. So before we dive in, we need to talk about what we're going to focus on today, if you will. First and foremost, let's talk about what an option is. Whenever we're dealing with exercise and assignment, it really depends on the type of option that you have that determines if you have the right to exercise and or the obligation that leads to the subsequent assignment. So we have to do those foundational basics and the anatomy of an option in order to understand how that affects us as options traders or options holders. That leads to understanding the options pricing components. When we're selling an option versus buying an option, really goes to those foundational elements of understanding how an option is priced. If we understand how an option is priced, it leads to understanding our likelihood of being assigned, or if it makes sense for us to exercise or not. Topics that we will, and definitions we will definitely dive deeper into today to understand more on. Then we've got different types of options. There's something called an American option versus a European option, which just goes through the styles, which we need to understand because that affects exercise and assignment differently. We'll talk about then the process, some key statistics that you may not know or you may know as far as how many options are actually assigned or exercised or even expired worthless, which may be your goal. And we'll talk about what happens the day of expiration when you hold an option, a long option. That means you're an option buyer. And what happens when you're an option seller. And there are some items that are in your control and others that are out of your control. But if we understand our surroundings, then we can understand the impact of those surroundings. And therefore, that helps us make those better decisions. And of course, we'll talk about some risks and some of those out-of-box, one-off circumstances that's important for you to be aware of before they happen rather than after. So bringing up those risks certainly helps lay that foundational element to understand the complexities that are options. So let's go ahead and dive in. And of course, keep this question in mind. I know that was a large agenda, but what we want to focus on today is how does the options exercise and assignment process impact me? Because you're the options holder. In this case, did you buy or sell? Perhaps there's even a multi-leg strategy, a covered call. How does that affect you? That's really the goal of today, is to understand that to help you make more informed trading decisions. So let's start with the basics. What is an option? An option is simply a contract between a buyer and a seller. When you are purchasing an option, your goal is for that option to go up in value as much as possible. And that's because the options purchaser, the options buyer, another word for that is a long option, you own the execution rights. You own the right to buy or sell the security, and the seller is obligated to fulfill the other side of that. So what does that exactly mean? If it sounds like a lot of legal jargon, that's because it is essentially a contract. And it's decided if it's a call or put, or excuse me, that option is issued as a call or a put, which is going to give you the indication if it contains the right to buy or if it contains the right to sell. So in this example that we see on the screen, you have a buyer that is giving the premium to the seller. The buyer is the one that is paying for that option contract. They're paying the value. Therefore, they are buying the right to execute upon the terms of that contract. The seller is receiving that upfront payment. We call that an upfront credit, and they're obligated to fulfill the terms. So in this example, you see 100 shares of ABC with $100 per share, and it has an expiration date attached to it. That means if this were a put, the buyer of this option would pay a premium for the right to buy 100 shares of ABC at $100 per share at any time through the expiration period. If it was a put, the buyer would have the right to sell. And then the obligation, someone has to buy or sell those securities, be on the other side. That falls on the contract writer, we call it. That's why it's called a contract writer. They are the seller of the contract. They're obligated to fulfill the terms that they agreed upon. So those are the basics when we are thinking about options. And when we're going to shift this, if you've attended any of the previous sessions or looked at BMO's course, we tend to think of options as drivers and sellers. So I want you to keep your mind around that as we go through today's presentation. When we're buying an option, you're in the driver's seat. You are the one who owns the execution rights. You decide if you can go left or right. Whereas if you are an option seller, you're on the passenger seat. You're obligated to go left or right at the buyer's discretion. But we can pay attention to our surroundings. And paying attention to your surroundings is really understanding. And that leads to anatomy of an option and how an option is priced. So in this example, when we have an option contract, there are some questions that we ask, which is what quantity are we agreeing on, what product, what price, and what time frame. This is all jargon for just really what comprises an options contract. The quantity is the contract amount. One contract generally represents 100 shares. So if you see one contract, think 100 shares in your mind. Do I have the right to buy or sell 100 shares? We're always looking at it at the lens of the person in the driver's seat. What product, that's the underlying security, can be a stock, ETF, exchange traded fund, index, currency, a commodity. In this example, we're just utilizing ABC. So this contract represents 100 shares of ABC. The price, that's another word for strike price. That's price per share. That's the price that it's agreed to buy or sell. So in this example, $100 per share. And then the time frame, that's your expiration, normally on Fridays, but as of late, as more products are being issued, you can find options expiring almost every single day. But that's the complexity that's added to options. Not only is it derived from the underlying security, like ABC here, but there's only a time frame that this contract will exist. And once that time frame passes, the contract ceases to exist. So knowing that time component is very important. And that is called the premium. So the option is issued, like I said before, as a call or a put. A call is going to contain the right to buy, a put, the right to sell. The option can be exercised. And remember, if you're in the driver's seat or you purchase the option, you are the one who owns those execution rights. You do that on your terms. It can expire, which may be your goal, like the term of a short option holder. They don't want the option to go up in value. They really just want it to deplete in value, which could happen with time decay or price movement, hence those complexities we have to understand. Or it can be traded, which is then traded for a price known as the premium. And the premium is what that option, or at least what the market believes that option is worth. And that premium is comprised of two components. We've got intrinsic value and we've got extrinsic value. I've got a little trick for you just to keep that in your mind as we go through this quick review. Intrinsic value is really the internal factors that affect the option. So in the case of a call, remember a call contains the right to buy a specific amount of shares within a specified time frame. In our previous example, it was 100 shares of ABC at $100 per share. So if I have the right to buy ABC at $100 per share, it has executable value if it's also called in the money, if it has a more favorable price than the market. So for example, I have the right to buy at ABC at 100. If ABC is at 110 per share, well, that contract has to be worth at least $10 per share because I can take the terms of that contract, buy 100 shares of ABC at $100 per share, take ownership of those shares, and then immediately sell it at the market for 110. So that's $10 of executable intrinsic or in the money value. Again, those are synonymous terms, but it's important to know that an option contract cannot have any in the money or executable value. It really is determined by price, which is the internal factor that affects the options premium. The external factors, also known as extrinsic value. So the external factors, also known as extrinsic value, is comprised of time value and implied volatility. Think about the logic behind that. The more time the option has until expiration, the more expensive it's going to be because the more likelihood or the more time it has to get that executable value. And implied volatility, that is really events that could inflate the options premium. So extrinsic value inflates or deflates really based on the likelihood of it having executable value. So those are external factors where you can find a lot of resources on how to understand the effect of an options premium. But from the premium perspective, that you need to know in understanding exercise and assignment, like that example we had before, bringing it into real terms. We have ABC stock at 103 per share, and we still have that same ABC 100 strike call with 30 days till expiration, and it's trading at $5 per share. Well, that means there's in the money value of at least $3 per share because, again, I own the rights to buy ABC at $100 per share. The market is pricing it at 103. That means that I can make at least $3, 300 total because one contract represents 100 shares. But that options price is $5 per share. So the excess is what becomes the extrinsic value. And that extrinsic value is those external factors that are constantly inflating and deflating. And that time value component is always moving against us. So therefore, it's something to consider when it makes sense to exercise or the likelihood of assignment really matters to understand how an option is priced. And we'll dive a lot deeper into that as we have some examples. But in order to understand that, which is a very frequently asked question, will my option be assigned or should I exercise? It's imperative to understand how an option is priced. Now, if that seemed like a lot, because that was a very quick review, we have a little trick for you that we like to utilize. This is called a T-chart, and you may or may not have seen this before. The intent of this is because options can be complex, they are essentially a mirror. If you focus on long calls, which we're going to use in a lot of the examples today, you can come back to this T-chart and figure everything else out, for lack of a better word there. The way that this is comprised, we have calls on the left-hand side and we have puts on the right-hand side. And what you'll notice is long calls are going to be on the upper left-hand quadrant, and then we've got short calls below that. Short puts, we're going to switch it up here, are going to be on the upper right-hand quadrant, and then long puts below that. And what this does is it puts bullish strategies on the top and bearish strategies on the bottom. And what's important to keep in mind here, because now we're shifting to understanding exercise and assignment and know that this is all based off of option strategies, is the practical application of it all. When you're deploying these strategies individually, there is a goal associated with it because it's derived from an underlying security. So you perhaps have a sentiment on that underlying security, but then you also understand those external impacts. So the takeaway that you just keep in your mind as you're looking at this, when I purchase options. I own the execution rights. I expect a sharp directional movement because I want that option to go up in value as much as possible, but I paid a premium for that option. And that's something that could work against me because that premium has an extrinsic value component, which is time value, which is a decaying factor. Whereas on the flip side, if I'm selling an option, those short puts are directional, yes, bearish and bullish. So bullish and for a short put and bearish for a short call, but they are neutral with a slight directional bias because those contracts individually realize their maximum profit potential when they decay in value. So the inverse, a long option holder is in the driver's seat. They want the option to have as much value as possible, and they own the execution rights, whereas the short option holder is in the passenger seat, and they're looking for that option to deplete in value. So the long option holder and the driver exercises, short option assignment. Keep that in mind, and of course, we'll give you some intricacies and make sure you understand that all the way through. Now, if that wasn't complex enough, let's introduce a new term, which is American versus European styles. You're probably very familiar with American style options. That's equity options. That means that they are physically settled. What does that mean? Well, we've had some examples of ABC stock before. I can take ownership of ABC stock. It's traded on the secondary market, so I can go ahead and buy that stock. So that's what we mean by physically settled. Those can be exercised at any time because I own those execution rights. Whereas a European style option, think about an indice or an index. You can't purchase an index directly. You can only purchase a product that mirrors that index like an ETF. So for example, you can't go buy the S&P 500 or SPX, but you could buy SPY, SPY. SPY, that ETF that mirrors the S&P 500, is an American style option because I can physically own the ETF. Whereas options, which can have a product derived from an indice, like the S&P 500, that's a European style option, which it's cash settled. So the difference of the in the money value at the day of expiration is what's decided. So breaking that out a little more, I've got an example for you here. If we've got a long equity call and a long index call, the long equity call is going to be American style. The long index call is going to be European style in this case. If we have a SPY call that is $430 a share at $10 and SPY is at $440, well, this is a call. I can buy SPY at $430, immediately sell at the market at $440. That $10, that's the in the money value. This is worth $1,000 total. And if this was the day of expiration, remember on the day of expiration, an option is normally worth only its intrinsic value. So we would expect that extrinsic value to deplete. That can change rapidly, of course, on that day of expiration, but generally that's what occurs. So I would be able to generally close this out for $10 per share. Whereas a long index call, so the underlying now, that's what we're changing, is the indice, not the ETF that mirrors the indice. If we have a call that's at 4,400 and SPX is at 4,410, which is definitely far away from right now, that's $10 per share of intrinsic value. So the same here applies, and that multiplier equals a dollar amount. So $10 times $100. That's the multiplying factor that's there. We'd be credited $1,000 to the account. So the monetary value is essentially the same, but what's different is the underlying product. And since there's a different underlying product, we have different styles of options, which is American and European. So one is going to be settled in cash, and the other would switch ownership of the underlying security. In this case, it's the exchange traded fund. Now, there are different items and nuances that go into index options, but what I want you to take away from this is the exercise style, because that's what we're focusing on today, is understanding exercise and assignment. This does vary, but generally, equity options, American style options, you can exercise at any time. Since they can be exercised at any time, so back to the driver and the passenger, that means there's assignment risk at any time because there's an obligation associated with it. When we're trading index options or those European style options, you remove assignment risk except for the day of expiration because they can only be exercised on one day, which is the day that they expire. Otherwise, they're traded on the secondary market, both of which are traded on the secondary market. So that's the important item to take away from this is how does the exercise and assignment process affect the different types of products? And that's all we'll focus on index options today. I know we have another webinar, another material that you can definitely dive deeper into. So let's focus on the assignment process. There's so many questions and understandings of how does this actually occur? And oftentimes this question comes up the first time you're surprise assigned, meaning not on the day of expiration. So going back to the equity options or American style options. And that's because there's someone sitting in the driver's seat and that's a long option holder. So in order to exercise an option, the long option holder is going to have to contact their brokerage firm. Their brokerage firm is then going to take those instructions, could be online or calling directly, and send that to the clearing firm. The clearing firm is then going to have to find somebody who is short that option, an offsetting seller. And they're then going to go randomly assign another brokerage firm. Could be the same brokerage firm that that long option holder was at, could be a completely different one. And then once that brokerage firm receives those assignment instructions, they're going to take their short options holders, either randomly or first in, first out. That's determined on the brokerage firm. And then that's the person who is assigned. So it's exercise and then exercise and then subsequent assignment. But it's a longer process than most realize. And what is important to know here is the long option holder does not know the strategy on the other end. They do not know that you have a covered call and your shares are going to be called away. All that they know is they own a contract that gives them the right to buy. You sold a call in that example of a covered call, but you're obligated to sell them those shares when they want to execute upon that. And that's a process that could catch you by surprise, but you have to pay attention to your surroundings and understand the premium in order to understand if you will be assigned or not.
Jessica, can I jump in?
Sure.
First of all, great recap on just kind of some of the foundational fundamentals of options and how they work. Super important, obviously, for this topic in terms of exercise and assignments. And so, assuming I sold an out-of-the-money option with 30 days to expire, which later becomes in the money before expiry, what is the likelihood of my option being assigned since the regulators assign a broker at random? Are there any insights on criteria for who gets assigned and how? Can you expand on that a bit?
Yeah, absolutely. And I think it's great to bring in a real example to that question. So thank you for that question. If you've got an option that was out of the money initially, so like that covered call example, and then it moves in the money, or maybe it doesn't even. It's all about paying attention to your surroundings, and you have to look at it through the lens of the long option holder. Does it make sense for that long option holder monetarily to exercise those contracts, which goes back to understanding the extrinsic value. When you are exercising your option contract, the question that your brokerage firm normally asks you, or that offsetting position, would be, are you giving up any extrinsic value? And if you are giving up any extrinsic value, probably not a wise decision to execute upon the terms of that contract. And there may be reasons too, which we're gonna discuss in a moment, but that's what you would pay attention to, is if I was in the driver's seat and there is a red light or a stop sign ahead, are they going to stop? But you need to know that there's something ahead. And that something ahead is there extrinsic value left pricing into this option? So pulling up your option chain, pulling up a quote. If the answer is yes, then your likelihood of assignment is low. If the answer is no, then your likelihood of assignment drastically increases. And remember, you sold an option, so you're obligated to fulfill the terms of that option at any time. The question is, does it make sense for you to fulfill those terms in the eyes of the person who is driving, which is the long option holder? It's a great question. And I think it's important to show some statistics around this. So 7% of options are actually exercised, 23% expire worthless, and then the excess are traded on the market. And that goes back to that same scenario. The person who is long that option, paying attention to your surroundings, does it make sense for them to own those shares? Or do they have the capital to own those shares? Depends on the strike price and the other person. And you don't know that information. But if there is a market, there's a lot of volume, there's liquidity, they normally can sell to close that option for that intrinsic value component. If they cannot, then there is a likelihood of exercise subsequent assignment occurring. But what's important to note here, having an option expire worthless may be your goal. In the case of a covered call, that's where you realize your maximum profit potential, is the underlying just reaches your maximum strike price and then it stops there. That's an expiring worthless option, which is good and maximum profit potential for the terms of the covered call or the covered call option trader. Whereas the long option holder, that is not for them. And that would, expiring worthless, would just exit that security from their account. So options can be purchased on the secondary market, purchased to open. They can be sold to open. They can also be purchased to close and sold to close. And you can do that before expiration. And when holding an option till expiration requires this layer or this level of extra attention, because now you have an option where we have to understand, what can we do on the day of expiration? Is it in the money? Is it out of the money? Is it close to the money? Will it move there by the end of the day? And that requires a lot of attention, which could equate to risk. But that's also why I love to start this presentation with understanding extrinsic value, because when we're purchasing an option, time value is working against us, and holding an option till expiration means time value is completely gone. When we're short an option, that just increases our risk that we're in maximum profit potential, but it could move adversely at any time. So the day of expiration adds risk to your option, which requires extra attention. Risk requires attention, certainly. So let's go through what happens the day of expiration. So in this example, we've got long options. Let's focus on that. An ABC stock is at $105 per share. And we're going to look at what happens if you hold an in-the-money option, a near-the-money option, and an out-of-the-money option. Now, remember, if we're a long option holder, you own the execution rights. You can exercise. You are in the driver's seat. So we're looking at the driver's seat in this case. Now, if ABC is at 105, your in the money option is that ABC 100 call. So day of expiration, 0 days here. You can sell to close your option if a market exists for $5 per share, $500 total. That's option one. Remember, a market has to exist. Two, you could exercise those contracts, but remember that requires capital. Do you have enough capital or buying power in order to own 100 shares of ABC at $100 per share? Or you could submit a do not exercise. What does that mean? We get that question often as well. Well, on the day of expiration, you could say, I don't want to exercise the terms of this contract. I want to take the obligation and put it on me. So what you could do is submit a do not exercise with your firm. And then you are saying, I intend to sell to close these options, or I just don't want that exercise to happen. And usually that occurs when you, one, are holding an option till the day of expiration and have that increased risk, or two, you do not have the capital required or don't intend to purchase the shares. You just want to trade them on the market. And you can see the extra risk that happens on the day of expiration. And what your firm can do for you, and lots of firms do this as a very big practice, is submit the do not exercise on your behalf or close out the options. And sometimes you may not even know. And that could be because you hold this option in an account where the exercise could not be supported. And that could overbuy your account and lead to a lot of other issues. And that's something that you personally don't want to wake up the next Monday or the next trading day and all of a sudden see your account overbought, or in the case of a put, could even be a sold stock. And so that's what we mean by heightened risk to pay attention to. If you hold a near the money option, that risk still exists because the option can move in the money or out of the money really, really quickly. And depending on the events of the day, some unknown and some known data events, that can is likely to occur. You could attempt to close, but remember you have a long option. So your extrinsic value is gone. If you need to sell to close that option, someone else has to buy it, whether it's a market maker, an exchange, however that's executed, or someone else. If there's no bid available, you may have a difficult time trying to close that option. You can also exercise that option, wouldn't necessarily make sense in this case. And you could also submit a do not exercise, but the risk still is present with what your firm can do because you hold a near the money option at expiration. It can move in the money at any time, and if your account can't support that, then steps might be taken to ensure that doesn't happen, which would be closing out your options on your behalf or submitting a do not exercise. And again, that could occur without your knowledge. And that's a risk that you take when you're trading options and holding them to the day of expiration. And then last is holding an out of the money on expiration. Your likelihood of exercise is low at this point. When I say exercise, the OCC accepts there's something called auto exercise that occurs on the day of expiration if your option is in the money by at least 1 penny. It's the way that the clearing firms ensure that you receive that value. And the only way that auto exercise doesn't occur is if you submit contrary instructions, which is that do not exercise that we're speaking of. You can still submit do not exercise or those contrary instructions, regardless if the position is in the money, at the money, or out of the money, because the person who can do that is in the driver's seat. Only a driver's seat can say do not exercise. There cannot be a do not assign. Otherwise, everyone would do that. Doesn't make logical sense. So in this case, the 110 call, it's out of the money by $5, but it could move $5. So you still have that risk. You can allow it to expire, but if it moves adversely, it could put you in a worse situation. So that's as in you could be assigned. There could be a lot happening here, exercised. You could submit a do not exercise, and then your firm can have the same negative implications. So that's something you have to be cognizant in. And the point or the key takeaway for this is holding an option till expiration, especially if you're a long option holder, you're giving up time value. And when you're giving up time value, that's something that you purchased. You bought to open that option. You bought to open time. You can also sell to close time. And that's something to be cognizant of if you're purchasing options. And that's why it equates to risk on the day of expiration.
So Jess, I'm going to jump in again. This is a great slide, and that was a great walkthrough. And I'm going to ask what might be a really silly question, but I'm going to fire away anyways, because we have on the graph here, and I'm looking at the row where it says I hold an out of the money option. Is there ever a use case to exercise an option that is out of the money as you approach or at expiration? Is there ever a use case to do that, or is that just a really silly idea?
That's actually a wonderful question, because there's use cases for so many things, and there's those one-off examples that we'll certainly go into a little more detail. But again, it's the long option holder. Does it make sense? So the auto exercise occurs when the option is cut off. Options stop trading normally at 4 p.m. Eastern time, and broad-based ETF options are about 4:15, then it varies for index options. So remember, submitting exercise instructions are on the terms of the person who is in the driver's seat, which is the long option holder. There could be some type of event that occurs post 4 p.m. and there is a window, it's an hour and a half window, where that underlying security could go up in value. There could be a tweet or X, formerly Twitter, whatever we call that now, come up, and that would make the underlying security move up or down in value. And it would make sense for you and the long option holder to submit exercise instructions, because that clearing firm accepts it until 5:30 p.m. Eastern time. And that's the only time only way you'll collect any type of value on that underlying security. You can't close it out on the market because the market's closed. So that is a one-off event. It occurs ever so often, but it also really brings awareness to the person who's short that option, really what they should pay attention to and the risk that's there if there is an out of the money option, especially if it's closer to the money and not those further out, and those high beta securities like Tesla or Nvidia, where something could happen where it skyrockets that security or causes it to decline, which means you have to pay attention to that underlying security, especially if you hold an option the day of expiration, because that can happen. There is an hour-and-a-half window from when that option ceases to stop trading where exercise instructions are still accepted by the clearing firm. And that could be an event where you may want to exercise those out of the money options, because even though they closed out of the money, they moved in the money after hours, and those exercise instructions are still submitted. Which means, as a short option holder, you do have to pay attention beyond when the option stops trading. And we need to focus on those events, because now we're moving to the passenger side of the equation. And this is the part where items can take you by surprise, and we don't want to be surprised. And the way that we can at least prevent those surprises with trading is understanding when those risks occur of us being surprised and paying attention to our surroundings. That's really, really, really the lesson today. So same scenario, ABC stock's at 105 per share, and you're the short side, the passenger holder, and you have let's look at the situation of a in the money option. So you hold a short in the money option, you hold a short at the money option, or a short out of the money option. So you're in the money option, you've got some risk, you've created an obligation to sell the shares. You could attempt to buy to close now, because remember, you sold to open. So we're going to do the inverse. We're going to buy to close for that intrinsic value of $5. That's why we look at it through the lens of the long options holder. You could allow assignment. So if this was a covered call, you could allow your shares to be called away, and you created that obligation to sell those shares at that strike price. Keep that in mind. What your firm can do is close out those options for you, especially if there's heightened risk or if there's a naked option. You could potentially create a short position in your account, and there are lots of requirements and heightened margin requirements with short options, which means there's additional risk associated with this. If you have a near the money option, the same risks apply. You could attempt to close, but remember, you're buying to close. Someone has to take the other side of a trade. With every trade, there is a buy and a sell. So this is where we look at the bid and ask. Is there something there available on the market? It could be difficult because there has to be a market. You are risking assignment. So in the case of a covered call, you may not want your shares to be called away. The only way to remove assignment risk is to close the contract. That is the only way, because then you doesn't exist and you don't hold the short option, which could be subsequently assigned. Your firm could close out the option for you, again, for the same reasons of you holding an in the money option. Now, if you have an out of the money option, and again, this is where it could depends on how far out of the money it is, and that's where you have to understand the way an option is priced and your personal preferences and goals. But in this case, the 110 call, it's $5 out of the money. You could attempt to close it. Someone may not be willing to buy that far out of the money option, or sell that out of the far out of the money option. There may not be a market. So that's why we say attempt, and that's why there's risk that's there. Or you could allow it to expire, which then you have that overnight risk, like we were talking about before, with that hour-and-a-half time from 4 p.m. to 5:30 p.m. Eastern time, where clearing firms still accept those exercise orders, especially if you have a high beta security, that there is heightened risk by allowing that to happen. And your firm can still close out those options for you. It's less likely, but they hold that right. And that's because they don't want to put you in a worse situation where you sell shares that you didn't necessarily intend to, or end up shorting shares. There's a lot that can happen in that case. And it really depends on the circumstances, such as volume even and risk of that day. So it is a case by case basis. So the takeaway is holding an option till expiration. If you're a long option holder, you're giving up time value. If you're a short option holder, you're putting yourself in risk of the underlying moving adversely. And you might have been at your maximum profit potential, but you may move against you. So be cognizant of what happens on the day of expiration.
Jessica, I'm going to jump in one more time if you don't
Sure,
mind. And
absolutely.
it's specific to that same bottom row again, right? If I'm holding
Hmm.
an out of the money option. So maybe using a bit of an example, right? Like if I'm short an option that has now moved in the money, what should I consider to help make a decision to either close the option or allow assignment? Is there any criteria that you might be able to offer as far as how I might want to think about that?
Absolutely. And that is, I want to say, the most common question that we get when we're talking about exercise and assignment. So, in the case of a short option, and it really depends on the underlying security, your sentiment, and goal. That's why we start this presentation with understanding your sentiment with that underlying security. So, in the case of a covered call, you're owning stock. And the reason you're owning stock is because you expect the underlying security to move up in some way, shape, or form. You're bullish on that. When you create a covered call, you're capping your bullish potential by creating an obligation to sell those shares at a strike. So you have a question now to ask yourself, which really ties back to your original investment thesis and your sentiment. In the case of a covered call, you initially sold something out of the money, so you gave yourself some room for some capital appreciation. You have to say, okay, am I all right selling these shares at this price? Because remember, that's even though it went in the money, you still made a gain on that scenario. You might still be bullish on that security. So perhaps you want to go ahead and recreate a cover call, or you could even roll it out and up or down depending on your sentiment. And that is the beauty of options, is even though there is this layer of complexity, we tend to look at that market in two dimensions, up or down. When we add options, we give path because we have a time frame, and we can look at an options chain, and there is a lot of data, but we could say, all right, where do I feel the security is going to go, by what time, by what price, and what obligation do I want to create, and the sense of a covered call. So it really comes down to, if you are assigned because it went in the money, your likelihood of assignment here. If it suddenly moved, do you still want to own that underlying security? Or conversely, if it's close to the money or still at that point where it looks like it's going to expire worthless, but you don't want to have that risk of assignment, then it may make sense for you to close out that option, because that's the only way that you completely remove and eliminate that risk of assignment, is by no longer holding that obligation or that short option. And if it's at the day of expiration, you know that an option is generally worth only its executable or intrinsic value. Whereas if we're looking prior to expiration, there's still that extrinsic value component that's there, but this shifts and adjusts depending on how the options price reacts. So it's really your sentiment on where you feel the security is going to go. And understanding the options premium is really a foundational aspect of all of options trading. Hopefully that answers your questions, but it's a really great question. But that also adds light as to why it's very important to add extra attention when you're holding a short option. When you're holding a short option, you have assignment risk because you're not in control of the situation. You're a passenger, and we want to pay attention to your surroundings. So let's look at a couple of real scenarios and those one-offs that may not happen so frequently, but when they do happen, we absolutely want to be aware of them. So let's take a look at some real life examples and start with a one off, which in this case is going to be the broken spread assignment. This occurs when we have multi leg options hold one short position and one long position. Remember, long option holders are in the driver's seat. You can initiate those exercises, but on the day of expiration, that could be auto exercised. And then the short options have the assignment risk. So when we hold a broken spread assignment on the day of expiration, there is increased risk, which means increased attention that we have to pay attention to. So it's important to understand the scenarios that occur within you hold these type of strategies. So let's look at ABC at 105 per share and start with the bull call spread. You've got a long equity call, so the right to buy 100 shares of ABC at 100 per share. You've capped your upwards potential at 110. That's pricing a net $4 altogether. Your long equity option, you own the rights to exercise upon the terms of that contract. So that could auto exercise, which means you would take ownership of those shares if it's not closed out on the day of expiration. Whereas the short equity call in this case would expire worthless. Why is this important? When we hold the debit spread in this case, or a net long position is what we call it, it was net purchased. You would also net sell that to close. You would expect an offsetting position. That's why it has a defined risk. That's why it's a defined risk position. You would purchase 100 shares of ABC at $100 per share. That would be the exercise. And then the auto assign would be selling your 100 shares at 110. The offsetting of those two would make a maximum profit potential of $10. You didn't reach your maximum profit potential in this case. You run the risk of just owning those shares. And again, it goes back to that long equity position, having enough capital required, because it was significantly less capital required in order to initiate this position. Since the underlying security didn't reach your higher strike price, you're not going to have that offsetting position. Therefore, extra attention is required, and you may need to remove that assignment risk or risk that's there. Flipping it over and looking at that net short position where you have a bull put spread. Remember, a put contains the right to sell, so we're flipping the equation altogether. So we have an ABC put with the right to sell at 110. Since we sold it, so the selling position, you have the obligation to buy. But this is more favorable than the market, so it's trading at $5 per share. That's the premium that's received there. Your obligation to buy would kick in, meaning you would be required to purchase those shares. So that is very, very important to be cognizant of. And you don't want that type of assignment risk, meaning when you purchase this and you purchase your 100 put, the reason that you purchased the 100 put is if it moved adversely. So you have your short 110 call, your short 110 put. You're going to realize your maximum profit potential when ABC is above 110. The reason why you're purchasing a long equity put at 100 is in case it moves adversely. If it moves adversely, because then your obligation is to kick in at 110, then you would have an offsetting position to sell it at, meaning you'd mitigate your losses if it were moving down. That's why it's individually a bullish position. So in this case, you have the risk of that broken assignment, because now your 110 put, your obligation has kicked in by $5. So same scenario, but it's an obligation rather than an auto exercise. You'd be required to buy. You still keep that upfront premium, but you don't have an offsetting sell position. And so that's why there's extra attention when you layer on more complex options, if you will, which is another layer, if it doesn't move all the way. And the same rules apply when you are deploying a debit spread, such as a bull call spread. You still are purchasing that time component. When you're deploying a credit spread, such as a bull put spread, you're still selling that time component. Closing those out prior to expiration removes risks such as broken spread assignment, something that doesn't occur often, but can certainly occur if you're trading something that is, depending on your strike selection, near the money, so on and so forth. Let's move on to another.
Jessica, I'm going to jump in if you don't mind. And like at the tail end of that, I think you somewhat answered it. And for our audience as well, like we obviously haven't gone deep into vertical spreads yet. That's actually an upcoming webinar. We look forward to bringing that to our audience. But since we're on the topic and we are using that example here today, do broken spread assignments happen frequently? I think you kind of already hinted they don't. But the part B to that is, what are some of the ways to minimize this risk when placing vertical spreads?
Yeah, and I think part B is such an important question, and the frequency, there really aren't statistics around it. It's one-off because in all reality, if you look at the overall traded volume, the vast majority isn't spreads. That's why it doesn't happen so frequently. But if you're trading them, they are likely to happen frequently depending on where the underlying security moves. So I think it's great to add some color to the why behind it doesn't happen frequently. It's because it's not something that's traded too often. Now, the B part, the only way to remove your assignment risk is to remove the option. We did a wonderful webinar on the Greeks, and we don't have to go into the details of that, but there is something that occurs, we call it gamma risk, which is just sharp directional movement risk, or time decay is getting in our way, theta risk. That risk is a trade-off that happens on expiration. You lose your time value, and because you're losing your time value when an option is at expiration, you're increasing the option sensitivity to the underlying security because it's only worth its intrinsic value generally on the day of expiration, which means movement can happen on the day of expiration for your short option holder, regardless if it's spread or not, causing it to be in the money all of a sudden, which then it's going to be assigned, even if it was out of the money. And for the long option holder, that just means you're giving up that time value component. So either way, there is a risk of some sort that's heightened on the day of expiration, whether you are long or short, multi-leg or not. So it's a really great question. And it all comes back to really understanding how an option is priced and then the external impacts, as well as the internal that affect that price that leads to the likelihood of assignment, which how does that equate to risk? And holding it to the day of expiration is different risk, but still risk exists whether you're long or short the option. But the most common early assignment that occurs would be using a covered call. When we hold a covered call or you deploy that type of strategy, generally you're looking to add some income to your portfolio. And the way that stockholders add income to their portfolio is generally via a dividend. In order to qualify for a dividend, you have to own the stock the day before the X date. That puts you on the correct days for record. When you're assigned, so remember that process that occurs, that longer slide where the long option holder initiated it. You normally don't know until the next day because it has to go through your broker or clearing firm. Then they choose a broker and the broker chooses the offsetting option writer. Because of that overnight process, you don't know until the next day, which can catch you by surprise if you have to, 1 day period, you have to hold the underlying security on market close the day before the X date. You don't know if you were assigned early until the following day, and that can certainly be surprising. But there's ways to check your surroundings and understand if that will probabilistically or have a high probability of occurring. So for example, if you own that ABC at $100 per share, and we're looking at very close to expiration and you own a call or you're short that call, that's around, we'll say 102. So the stock's at 100, the call's at 102. Well, if there is a dividend that is more than $2 per share, which is an extreme example, but this is the surroundings that you have to pay attention to, it makes more sense for the person who owns that stock to go ahead and exercise. So you really have to pay attention to, does that my person, as me being the long option holder, is there any value in me exercising versus closing it out in the market? And what we have to look at, if owning that stock plus the dividend that I would be qualified to receive is more beneficial than selling to close it on the market. That's a scenario that is highly likely. Now, there is a big debate about that. I've done the math with lots of people at clearing firms, actually, and it doesn't make sense because of what occurs. However, people do it all the time, very often, and that's this perceived value that occurs. So I think it's important to bring this risk awareness to anyone who holds a short call the day before an X date. So the takeaway, pay attention to options that are short on the day of expiration. It's heightened for a covered call the day before an X date, in addition to the day of expiration.
So just I'm going to jump in again. I think you're answering, but I want to make sure it's clear. And so do early assignments occur more frequently on dividend paying stocks versus non-dividend paying stocks?
They tend to, yes. So don't have the statistics off the top of my head, but the likelihood is higher because it's the way that the long option holder can capture additional value that's not reflected on the bid and ask, or at least they perceive that. And since that occurs, there's a highly likelihood of assignment. But really good question. Yes, that occurs. It catches people by surprise, especially those account holders who are looking to receive dividends. So we just have to do a little math. Is the option bidding more than the intrinsic value, if any, plus the dividend? And that's all we would look at. But great question. All right. And there is one more very one-off circumstance. I like to call this one surprise assignment. So recall how the OCC or the clearing firms receive instructions for that hour-and-a-half period post the stock and the option stop trading from its normal hours, 4 p.m. So 4 p.m. to 5:30 p.m. Eastern time. Because there could be some calamitous event of some sort, like a tweet, and this is an example that occurred honestly with Tesla. There was chatter news within that hour-and-a-half period. The underlying security shot up in price, and the only way that the long option holder could recognize any value is via exercising and taking ownership of those shares, because then they could sell them in the overnight market if they'd like, or hold them to whenever. We don't know the intent of the long option holder, but what we do know is that is a way to capture value. And because there's a way to capture value, like the previous example, your likelihood of assignment is higher, even though you thought that your option, your short option, closed out of the money. So in this example, say you've got a short ABC 200 call, and ABC on March 31st closed at 195. So $5 out of the money, didn't make it to its price. You perhaps have a cover call and you say, you know what, I'm not going to be assigned. It's 4 p.m. Have a great weekend. Lovely trading. I kept my stock in this scenario. However, post market, ABC jumps to 220, and they did that before 5:30 p.m. Eastern time. Think about the long option holder, the person in the driver's seat. The only way that they could capture any value is by submitting exercise instructions. They own the right to purchase at 200 per share. They could purchase at 200 per share, take ownership of that. If there's a market, they could sell it for 220 in the overnight market. That's a possibility, or they could hold it over the weekend to the normal trading session. But the point is, that's the only way that long option holder can realize any value on that option contract. So therefore, you are subject to that risk of surprise assignment. Something to be cognizant of, and just really, really drive awareness to holding an option on the day of expiration really does lead to heightened risk, especially if you're a short option holder, because there are a lot of events that could occur that could find you in a situation that you did not expect. So the takeaway really is understanding those pricing components and the risk that you are really okay with when you are trading options, especially on the day of expiration. All right. So that concludes today's presentation on exercise and assignment. And I know exercise and assignment, that is some terminology we like to throw around in the options world that can certainly seem complex, but it all begins with just understanding how options work, understand how options are priced, understanding the events that surround the option, if it makes sense for you to exercise them. And if it makes sense for them to be exercised, it probably means you're going to be assigned if you're a short option holder. So really complex can enhance a portfolio, but they are complex, which just means we need to understand them more. So thank you for taking that time today, and I certainly appreciate it.
Well, thank you, Jessica. I think you did a wonderful job. Obviously, it can be a complex topic, option exercise and assignments, and at the same time, with a solid understanding, I think anyone can really navigate, especially expiration, with confidence. And so, hopefully, a lot of the content and the commentary that you shared today will help all of our audience. So, a big thank you, wonderful job once again. And we look forward to inviting our audience back as our next webinar will dive into the topic of multi-leg strategies, and we'll go a little bit deeper on debit spreads, which we got a bit of an introduction into today with some of Jessica's examples. So thank you, Jessica, once again, and thank you to our audience, and we look forward to seeing you again on our next webinar for multi-leg strategies, where we'll zoom in a little bit on debit spreads. Thank you. Have a great rest of your day.